Insurance, it's a word we hear all the time, right? But what does it actually mean? Well, today we're going to peel back the layers and get right to the heart of it. We're going to break this whole thing down into something simple, clear, and really useful for your own life. Okay, so here's our game plan. First, we'll talk about why we even need insurance in a world full of uncertainty. Then, we'll take a look at its surprisingly ancient history. After that, we'll dive into how the modern system works, get a handle on its real power, which is called risk transfer, and we'll wrap it all up with 3 super simple rules to remember. You know, we all live with this basic question hanging over our heads. What's going to happen tomorrow? And that feeling of not knowing? Well, that uncertainty is the very reason insurance even exists. It all starts right here. I mean, think about it. Every single day, stuff happens. A fire, a flood, a car accident. These aren't just things you see on the news. They're unpredictable events that can totally turn someone's life upside down in an instant. So, what is it about these things that gives us so much anxiety? It's not just some random fear. It actually boils down to 2 very specific, very real problems. And here's the answer. It's really a 1-2 punch. First, you just can't predict them. If we knew for sure that a disaster was coming, we could get ready for it. But we don't. And second, when they do happen, the cost, both financially and emotionally, can be absolutely devastating. We're talking wiping out savings and causing just immense grief. But you know what? Dealing with this kind of uncertainty isn't some new modern problem. In fact, the solution we use today, this idea of sharing the risk, is thousands of years old. Just look at this history. It's amazing. All the way back in 3000 BC, you had Babylonian traders paying a little extra so their loans would be canceled if their cargo got lost. That's basically an early form of insurance. Then you have ancient Chinese merchants who knew not to put all their eggs in one basket or all their goods on one ship. They spread the risk across a whole fleet. Fast forward to the 1700s, and you've got traders literally meeting in a London coffee shop, shaking hands and agreeing to cover each other's losses if a ship went down. See the pattern? It's always been about protecting the community. So how does this ancient idea actually work today? Well, that core principle of pooling the risk is exactly the same. It's just a highly organized system now. And this right here is the absolute heart of it. Insurance is just a formal way for the financial losses of a few unlucky people to be shared by a much, much larger group. You can think of it as a community safety net, but on a bigger scale. This image is the perfect way to picture it. You've got a huge group of homeowners. Each one chips in a small amount of money, that's their premium, into one big pot. Then, when a disaster hits 1 or 2 of them, the money from that big pot is used to help them rebuild. See? Many, many small payments are used to cover a few huge losses. So the whole process has a few key parts. You have the group of people, the insured, who pay that regular fee, the premium. Then you have the insurer, the insurance company, who collects all those premiums into a giant pool of money. And when someone in that group has a loss that's covered, the insurer pays for it out of that pool. That payment, that's the claim settlement. Okay, but this brings up the most practical question of all, right? How do they decide the price? How much does each person actually need to chip in to make the pool work? Well, let's make this real with a quick example. Imagine a village with 400 houses, all pretty much the same. And looking back at their history, they know that on average, about 4 houses are lost to fire each year. The total cost to rebuild those 4 houses is, say, 80,000 rupees. The math here is actually pretty simple. You take that total expected loss, the 80,000 rupees, and you divide it by the 400 homeowners. And what do you get? Just 200 rupees each. By contributing that small, totally manageable amount, they create a fund that's big enough to cover a neighbor's completely catastrophic loss. And this, right here, brings us to the most powerful idea in all of insurance and why it's so incredibly valuable. It's a tool for something called risk transfer. So insurance basically gives you a choice. You can hold on to the risk yourself, that's called risk retention, and that means you're facing a huge, scary, unpredictable maybe of a financial disaster. Or you can transfer that risk to an insurance company. You get to swap that massive uncertainty for the small, manageable, totally predictable certainty of a premium payment. And this is exactly what that journey looks like in real life. When you have an insurance policy, it creates a clear, predictable path to get you from a chaotic accident all the way back to normal. Let's just walk through it. So you have your insurance, an accident happens, bam. You file a claim with the company. Then the company indemnifies you. Now, that's a fancy word, but all it means is they make you whole again. They pay for the damages to put you back in the same financial spot you were in right before the accident happened. At its very core, this is what you're buying. It's not just a policy document, it's peace of mind. It is financial certainty in a world that is fundamentally uncertain.
Okay, so to pull this all together, let's finish up with 3 simple rules of thumb. These are fantastic questions to ask yourself to figure out when insurance is actually worth the money.
So here they are. First, don't risk more than you can afford to lose. It's common sense, right? It's why you insure your house but not your favorite coffee mug. Second, don't risk a lot for a little. It would be crazy to pay a big premium to protect a cheap ballpoint pen. And third, and this is the most important one, is to focus on the right kind of risk. And that brings us to the real sweet spot for insurance. It's all about protecting yourself against those low-probability, high-impact events. You know, the stuff that probably won't happen, but if it did, it would be a complete financial disaster. A house fire, a major medical issue, that's where insurance truly provides its greatest value. So we'll leave you with this one question to really think about. As you take these ideas and apply them to your own life, what is the one asset, the one thing that you truly, absolutely cannot afford to lose? Your answer to that question is the perfect place to start thinking smart about insurance.